In this video, we master liquidity to minimize hidden trading costs. Liquidity is the measure of how easily you can buy or sell an asset without causing a drastic change in its price. In the options market, we gauge this primarily through volume, which is the number of contracts traded today, and open interest, the total number of outstanding contracts. High liquidity ensures that market makers are active, allowing you to enter and exit positions efficiently. Without it, you are essentially trading in a ghost town where fair pricing disappears. The most immediate impact of low liquidity is a wide bid-ask spread, which creates slippage. If an option has a bid of $1 and an ask of $1.50, the mid-price is $1.25, but you are forced to buy at the higher ask price. This spread acts as an immediate tax on your trade. The moment you execute, you are technically losing money relative to the fair value. In highly liquid markets, this spread tightens to pennies, drastically reducing your entry cost. Wide spreads force the underlying asset to move significantly in your favor just for you to break even. If you pay a 10% premium due to a wide spread, the stock must move enough to overcome that deficit before you see a single dollar of profit. This creates a statistical disadvantage that is difficult to overcome, regardless of how accurate your directional analysis was. We calculate this spread percentage to determine if a trade is viable. To identify liquid options, you must look for specific thresholds before analyzing a chart. Generally, look for open interest in the thousands and volume in the hundreds for the specific strike you are targeting. Furthermore, the bid-ask spread should ideally be less than 1% to 2% of the option's price. If you see a spread that is 10% or 20% of the price, avoid that strike regardless of the setup. The danger of illiquidity is most potent when you try to exit a position, a scenario often called the Hotel California effect. You can check in, but you can't leave. During periods of high volatility, market makers may pull their quotes from illiquid strikes, leaving you unable to sell even if your trade is profitable on paper. You may be forced to sell at a terrible price just to close the position, erasing your gains. Execution safety is as important as directional accuracy. To protect your capital, stick to highly liquid underlyings like major indices, SPY, QQQ, or high-volume large-cap stocks. Avoid trading options on penny stocks or companies with low average daily volume, as their option chains are often barren. Remember, as we discussed in Phase 1 regarding capital preservation, paying for wide spreads is a voluntary reduction of your edge. Always demand tight markets to ensure your strategy works as intended. Thanks for watching, and trade safe.